During these uncertain times, we felt like it was important for us to provide you with an economic update to kind of show you where we're at with this current COVID-19 crisis and compare it a little bit to the last recession that we went through in 2008 and 2009. Before we begin to look at some data, I think it's important for us to look at what we know and what we don't know. We know that many individuals are out of work. It's tragic. We've got 20 million people that have filed for new unemployment claims. We know that small businesses are suffering significantly as we remain shut down. We know that there are many large companies that are suffering, and in particular in certain industries like tourism and airlines, hotels, all those sorts of industries are really suffering. We know that there's been a disruption around the world in the supply chain, and that will have significant economic impact going forward, especially as we begin to recover. We know that we're going to see the GDP in the United States go down. We're likely entering a recession, which the technical definition is we've got 2 quarters of declining GDP. We expect that in the first and second quarter of this year. But also, it's important for us to realize that this will end, and it's not the end. We're going to look at some data from markets that show, markets respond to a lot of these crises like it's the end of the world. This is not. It's a tragic situation, but we will come back from this. Our economy will rebound over time, and we hopefully give you a little perspective on exactly where we're at. Now, there are a lot of things that we don't know. We don't know exactly how much GDP is going to drop in the first and second quarter. We'll look at some forecasts and try to come up with some ideas about where it'll be. We don't know what's going to happen in the second half of the year. Some of that's going to be dependent on how quickly the economy is going to be able to rebound. And we just don't know yet what that's going to look like. And we don't know exactly when this is going to end. How long will this economic slowdown last? How long will the recovery take? How long will the COVID virus be with us and still causing us this sort of economic shutdown that we've seen? So a lot of unknowns. And so we are in a time of uncertainty, and to a certain extent we have to be patient and understand that, again, over time, things will get better. So I like to jump in and look at a lot of pictures, to look at the data, to kind of see where we're at and talk through the situation. So first, I want to look at the markets. So this is a graphic of the S&P 500 index from Thomson Reuters. As you can see, obviously the market has fallen significantly. Right now, you can see that there's been a little bit of a bounce back. Right now, we're down about 17% from the peak. The absolute bottom, we were down about 34%. But if you contrast that with the last financial crisis, again, S&P 500 here from Thomson Reuters, you can see that the market here fell 50% during that time frame. And so a much more precipitous decline, and honestly a much slower kind of rebound than we've been seeing currently. We'll talk a little bit about where that market may go, and some of that's going to depend on where earnings go and different things a little bit later on. But probably not the level of severity that we saw during the last financial crisis. One indicator that I look at a lot, it's one of the so-called fear indices. What this is the Chicago Board of Options Exchange volatility index, and it's called the VIX. And so what this measures is the expected volatility in the S&P 500. So it's not the actual volatility, but the expected volatility is measured by market forces at that time. You can see during the last financial crisis, the VIX peaked out around 80, which is an 80% volatility, which means the market expects the market to go all over the place. In this last crisis that we had during the COVID peak, it actually went higher than it went during the financial crisis, which I think is kind of fascinating, but again, maybe an indication that markets aren't always efficient. They tend to overreact to these things. During the financial crisis, especially as you hit in October of 2008, you were really looking at a situation where liquidity across the globe was drying up. And in my opinion, we were very close to entering into a very steep recession, if not depression, even worse than what we saw. Now, fortunately, we had a lot of intervention by central banks all over the world, but still, that crisis was so bad at that time that again, it kind of surprises me that the VIX spiked so high during this. It just goes to show you the amount of fear that exists in the market right now is still there, but especially during the height of that pandemic when nobody really knew what was going to happen. And so a lot of fear in the marketplace. And what happens when you get a lot of fear in the marketplace? You get a lot of volatility. That's what this is reflecting. And so we're going to see a lot of kind of wild gyrations in the market over the next several months, probably, as we begin to return to a normal. So again, markets expecting a lot of volatility. So now I want to look at some of the macroeconomic variables. We kind of mentioned the unemployment scenario that we've seen. We have numbers up here from March. This comes from the St. Louis Fed, and the source is the U.S. Bureau of Labor Statistics. You can see here that the unemployment rate jumped in March to 4.4%. It will climb again in April because we've had more initial jobless claims come out. And so again, we'll probably see that increase for a while until the economy in the United States begins to open back up. The hope is that a lot of this is temporary. Those workers that were laid off or furloughed for a period of time because businesses were closed will come back, and the economy will rebound, and the unemployment rate will drop fairly quickly. Now, if you look during the last financial crisis, during 2008 and 9, you can see that the unemployment rate tends to lag a little bit the recession. The unemployment rate there actually peaked after the recession at 10%. One of the things about the last recession that was so difficult was the prolonged higher unemployment that we had. We didn't see a quick bounce back. The economy took a long time to recover. And so again, that scenario is much different than what we're looking at right now. Right now is, it's not a financial crisis. It's a real crisis. Everything's closed. So it's a much different type of scenario, and that leads us to be a little bit more hopeful that we'll see a quicker recovery. Now, related to that, as we think about recovery, this is again forecast from the Federal Reserve Bank of St. Louis. Their GDP forecast, what they do is they take a lot of economic news that comes out and come up with a quarter ahead forecast for GDP. You can see that they're forecasting a 15% drop in GDP for the United States for the first quarter of 2020. There are others, you look at Goldman Sachs or Morgan Stanley, that are talking 25-30% drop in GDP. That makes sense, right? Nothing's open. Nobody's doing anything. So obviously GDP is going to be down. Their forecasts are similar in the second quarter, that we're again still going to see this drop of anywhere from 8 to 20%, 30% I've seen. So it's kind of all over the place. We don't know. We don't know exactly. We know some industries are not doing poorly. Retail, a lot of the retail that's online, Walmart, Costco had good numbers the other day. So there are some of those that look okay. Anything consumer or business discretionary is gonna look bad, right? There's not a lot of discretionary spending taking place. We might see some impacts spill into the real estate market depending on how long people are out of work. But most forecasts that I've seen predict for the year of 2020 that GDP will be down about 8%. That means if we've got a really bad first quarter and a really bad second quarter, we're expecting some type of bounce in the third and fourth quarter. So again, some of that's going to depend on how quick things open back up. I think that, there will still be industries that will be struggling. Even as we open back up, again, a lot of those discretionary spending dollars are probably going away. Even as people come back to work, they've probably eaten into savings. There's probably a lot of things there that are going to limit both individual and business discretionary spending as we go forward. Next thing I want to look at is credit markets. Anytime we get a disruption like this, we see spikes in the credit markets. And when we have spikes and gyrations in the credit markets, that gets concerning because the business world is driven on credit. And if credit dries up, we end up with a problem. And so I want to take a look at some of those data for that. So what you see here, again, coming from the Federal Reserve Bank of St. Louis, is data from the Intercontinental Exchange, ICE. This is the Bank of America U.S. Corporate Index spread. And so what this looks at is the differential between highly rated corporate bonds, so what we would consider investment grade corporate bonds, versus treasuries, all right, of a similar maturity. And so when you look at this, you can see that, in the run-up before the pandemic, the spread there is about what we would expect, between 1% and 2% difference between corporate credit, high-quality corporate credit, and treasuries. When we get this sort of pandemic, you get two factors happening. First, you get kind of this rush towards quality. So not only was the Federal Reserve cutting rates, everybody was buying U.S. treasuries. And so all that buying puts further downward pressure on treasury yields. So you see the treasury yields dropping a lot, and then you see corporate yields increasing somewhat. People are afraid. They don't know what's going to happen. We saw that with the fear. So those borrowing rates for companies go up, and so that makes that spread spike during these types of crises. A lot of times what we see is an even bigger spike. And so this was during the last financial crisis. So you can see here the spike is almost double during the last financial crisis than what it was right now for this difference between high-grade corporate bonds and treasuries. And again, you see the prolonged nature of that, where it was higher for a much longer period of time. Again, the last financial crisis, a much more systemic, significant disruption in financial markets. We're not seeing that right now with this current crisis. Another thing you tend to see is the difference between your highest grade corporate bonds and your lower grade corporate bonds. You see that differential spike. So what you see here is the red line is your AAA, the highest rated corporate bond yields, and you can see those fairly low, right? Even during the spike, maybe 3%. But you look at the high yield end, so this is the riskier corporate bonds, those companies that are at higher risk of default, you see the huge spike. So up to 11%, and so the differential gets to be between 7 and 8%. That's a big differential. Again, when you get fear in that marketplace, the market looks at these companies that are risky, have a lot of debt, and they think, man, they're going to go bankrupt for sure. Those yields spike, and so you see that happening. Now again, when you look at the last financial crisis, look at the spike in those high yield bonds, 22%, almost double where we're at now, and the differential much, much higher, 16, 17% differentials. And again, that prolonged nature that we saw during the financial crisis, the high yield market really just kind of blew up during the financial crisis, driven by a lot of things. We're not seeing that right now. We're not seeing a lot of defaults yet. We're not seeing that sort of disruption in the credit markets like we saw during the last financial crisis. So that's a good thing. And again, hopefully, this doesn't last that long and we don't see these prolonged impacts. But these sorts of impacts are what caused the Fed to move. And so I want to talk a little bit about what the Federal Reserve has done in response to this crisis. I think they learned a little bit from the last financial crisis that sometimes significant intervention is necessary, and we're really in a new sort of different central bank model than we ever have been. And so central banks are much more inclined now to respond and respond dramatically when they see this crisis. And that's exactly what's happened with the Federal Reserve. So if you take a look, this is a Federal Reserve balance sheet, and kind of shows it from about 2008 then up to today. During the financial crisis, the Federal Reserve began a policy of buying all sorts of bonds. So they were buying U.S. Treasuries, they were buying mortgage-backed securities to try to interject liquidity into the financial marketplace. And so the size of their balance sheet, grew dramatically during that time and peaked out at over $4 trillion. So, that's to give you some perspective, the size of our balance sheet is larger than most economies in the world. It's huge. Now, look at what happened during this last financial crisis. Big time spike. The Federal Reserve is really pumping a lot of liquidity into financial markets. They're buying everything. You may have seen the Main Street lending facility where they're facilitating the purchase of these loans that are being made to small businesses. And that's created this gigantic spike in the Federal Reserve balance sheet. I think that this spike, a lot of it is somewhat temporary. You see a $2 trillion increase. A lot of that's temporary. Again, there's support of a lot of different sorts of lending programs to help liquidity. A lot of things they haven't done in the past, they're doing now. Much more focused on Main Street, smaller businesses, corporate lending. Even looking at some municipal bonds potentially. Lots of different things that they're doing. I think a lot of that's temporary. It'll come back down fairly quickly when things begin to stabilize. But they have pushed an enormous amount of liquidity into the market. One area where I get concerned as somebody who watches the Fed in terms of liquidity is the overnight market. And this is a graphic of the overnight market. Now, this is one of these kind of obscure things that kind of Fed geeks like myself kind of look at. But this rate, what you're looking at here, this rate is the overnight finance rate. So this is the rate at which banks lend to each other in the overnight market. This is what provides the liquidity that helps banks and other financial institutions open up every day and pay out deposits and whatever they need to do. This is the market that really almost collapsed during the last financial crisis. And if this market collapses, we've got a major problem on our hands. Now, what's been interesting here is you see this little spike, this big spike that kind of pops up there in around September of 2019. So the in financial markets, prior to a few years ago, we used something called the LIBOR rate, the London Interbank Offer Rate, was this overnight rate. That was something that we used. Now, you may have seen that there was a lot of controversy about the LIBOR rate. There were certain banks that were accused of rigging the overnight rate, and that created all sorts of problems. And so we are now switching to something called the Secured Overnight Financing Rate. It's an alternative, the kind of new alternative to LIBOR, but understand LIBOR still exists. So you've got these kind of two overnight rates going on at the same time. And so what you're seeing, you see these kind of this big spike or these little spikes. You're seeing this disruption in the overnight market. It's really driven by two factors. One is the demand by banks for reserves. So right now, the Federal Reserve Bank pays interest on reserves, excess reserves, that banks park at the Fed. When we see some disruptions like this, some of these little smaller spikes potentially, it's because banks, look at the financial markets. I really don't want to lend money. I'm okay just leaving the money there. So the Fed has to make sure that there's what they call an ample supply of reserves. That means their balance sheet has to be at a certain size. And what we were seeing in 18 and 19, you saw it on the previous graph, the Fed started to decline the level of their balance sheet, and then we started to get some of these spikes in the overnight market. So they injected a little bit more liquidity. Another reason for these spikes, though, is trading. You've got certain entities in the financial markets that are trading the LIBOR against the secured overnight finance rate, which can create some disruptions. There becomes a lack of liquidity in one side of the market, and that causes the rate to spike. And that's what we saw a little bit there in September of 2019. So it's an interesting market. Some of it's driven by Fed factors, some of it's driven by trading and disruptions that you see in the market. When we look at the short term for this is over the last month. This looks like a big spike here a couple of weeks ago or a week ago. But really, if you look at the rates, it's from zero, basically 0.01% to 0.06. But point being here, you're still seeing some of these slight disruptions that happen, and these are, I would argue, are generated by this sort of trading that's going on between the LIBOR rate and the secured overnight finance rate. But overall, I would say the health of the overnight liquidity market looks good, which is good for the economy, good for business, and probably lessens the overall strain on financial markets. This market seems to be functioning reasonably well. And again, if you contrast that with the last financial crisis, this market almost dried up. And so that would be a much bigger concern if that were to happen. So I'd like to just conclude with some outlook on what you might be looking for and things you might be thinking about. First of all, we've got earnings coming out now. This is earnings season, so companies are announcing their first quarter earnings. We're early in the process, still a lot of companies coming out. We've seen a lot of mixed reactions. It's been kind of hard to predict what the market's going to do. I've seen some companies come out with just really bad earnings and even lower than expected, but the market responds positively, I guess, because they were expecting even worse. But yet I've seen some companies have pretty good earnings and the market goes down. So the market is really volatile right now. I think as more and more companies announce and the market realizes that things are bad and we start to see the GDP numbers, I wouldn't be surprised to see the market dip back down again to maybe where it was at its previous low and then start to come back. I am concerned about disruption in supply chain. So, we really are a global economy now, and a lot of the goods that we need, let's say to make cars, for example, a lot of those parts come from elsewhere around the world, Japan, China, some in Europe. And so, again, we have this worldwide disruption, which we really have, that disrupts the supply chain. And so, if Ford wanted to just start making millions and millions of cars right away, they've got to have all their suppliers lined up to give them those inputs. And with all the global disruption, that's probably not going to happen immediately. And I think that this may add anywhere from 3 to 6 months in terms of an overall recovery to get back to the production levels and things where we were previously. When you look at the markets, there's clearly some industries have been hit hard, and there may be some good buys. Everybody always asks me, well, what should I buy? And I usually say, I don't know. But, you might look at airlines or cruise lines or hotels and things like that. Obviously, they've been hit really hard. A lot of those have bounced back to some extent. You may have missed the bottom, but again, wait till first quarter earnings. The big question with a lot of those companies that are in distress is, can they survive the creditors? And really, small businesses the same way too. Are they going to be able to survive and not be forced into bankruptcy? That's what a lot of the government programs are supposed to help out with for small businesses. And we're also seeing it with some large businesses, the airlines, for example. The government is providing somewhat of a backstop to them. And so that, to help them keep going. And, to the extent, to which there's more money in that pool, more of these industries and particular companies may be able to survive. The last thing I'd leave you with is, I think there will be some long run implications of this massive increase in the Fed balance sheet and the significant deficit spending that we're seeing. Out of the last financial crisis, when the Fed, increased its balance sheet to $4 trillion, it created a new paradigm in, monetary policy. And to a certain extent, I'm not sure that is entirely sustainable. How much debt can the Fed actually take on? They took on $2 trillion more. At some point, is that going to create, as we saw with that short-term overnight rate, problems when they need to start unwinding? And are we ever going to be able to fully unwind that? And I think when you've got so much central bank intervention in the long run, I think that might lead to lower economic growth because all that money just kind of sits and is tied up at the Fed. And then you get to the issue of deficit spending. Obviously, we've pushed out trillions of dollars, and we needed to help small business, to help individuals during this time. But we've got a massive federal deficit again, kind of in the same way. I think at over some period of time, that massive deficit becomes a drag on the economy. It becomes the economy. And you can see in different places around the world where countries that have had this level of deficit spending, that in the long run it has a negative impact on their long run growth. And so at some point, hopefully we hit a recovery and we're able to end the massive amount of deficit spending that we have right now. So I hope that you found this interesting. Look for more content coming from the Center for Principled Business. We appreciate you taking the time to listen, and thank you.